Alright, good afternoon then folks. We are at the end of another week of trading on Friday, the 3rd of November. We'll start with the economic calendar. We'll jump across to some charts in a minute and we will try summarise what has gone on over the course of this week. We'll start with growth figures, inflation figures out of Germany, out of France, out of Italy, out of Eurozone as a whole. Bunch of them missing estimates across the board, apart from Germany with GDP slightly above consensus, but ultimately it's still a negative print. Still, it's above consensus, but it's still a negative print, still below zero, indicates contraction within the German economy over the course of Q3. Inflation 3.8, consensus 4%, previous 4.5%, so below consensus, below previous. All three of those prints don't really suggest that the ECB need to continue hiking rates again. It is flash figures, so it's flash estimates. It is not the final figure, so it's not the complete final, this is what the number actually is. It is the estimates, which normally are pretty accurate for the most part. In the Tuesday then, we had GDP from France, not great, 0.1% growth in Q3. Italy, flat, no growth, no contraction. Eurozone as a whole, minus 0.1, below consensus. All pretty negative prints across the Eurozone. Less the Eurozone, you see the Eurozone figure itself, minus 0.1, does indicate contraction within the European economy. Inflation down from 5.3 to 1.8 in Italy, down from 4.3 to 2.9 across Europe. In France, down from 4.9 to 4, albeit in line with consensus. The other two did miss consensus. So inflation across the board, across Europe, decreasing, coming down. Growth flat to negative, flat to contraction, probably the better terminology. Certainly not a reason the ECB need to go and continue hiking interest rates, which was a reason for the euro downside over the course of Tuesday. It was bid slightly off the back of German figures beating consensus, inflation coming down. That move was reversed on Tuesday and the euro sold off. In the Wednesday then, we got the Fed and then the Bank of England on Thursday. Tuesday, the Bank of Japan, the most hawkish of the three central banks, which is not something that you will see very often, or have seen very often, certainly over the span of my lifetime. So we'll break down the Fed and the Bank of England. We can kind of kill two birds with one stone here, as they two of them are in a pretty similar situation in terms of their monetary policy settings. Not so much in terms of how the economies are performing. The UK economy performing considerably worse than the US economy itself. 4.9% growth across Q3 and positive or relatively positive earnings over the last couple of weeks from the US. So interest rates remain steady at 5.5 in the US, 5.25 in the UK, but both central banks are open to hiking interest rates again in the future. But the Fed somewhat kind of closed that door. That door was fully open to begin with. Markets didn't believe that they were going to go through with it, but it was fully open to that. We did get a comment from Powell suggesting that September's dot plot, which alluded to one more rate hike, may not be accurate. Both central banks have suggested to us that the full effect of interest rate hikes to date have not taken effect within their economies, which would suggest to me that both will be reluctant to continue hiking interest rates, and they will want what they have already done to take shape and fully affect the economies. Fed probably need a bit more of those interest rates to get the economy cooling down, but certainly the Bank of England will not want to cripple the economy. For me, Bank of England are done. 3 of the members in the committee think a rate hike was warranted, 6 did not. So overwhelming majority within the Monetary Policy Committee that interest rates do not go any further from here on out, barring any sort of a spike in inflation. The Fed reluctant to hike interest rates again. Markets don't believe they do it, and that gives you a picture as to what to expect from the US dollar going forward. Stocks, it's a tricky one with stocks. You got to buy stocks. I mean, does it make sense really if interest rates are 5.5%, and maybe they're looking out and seeing the next move from the Fed will be a rate cut? You got to put it down to that. Again, is it going to come anytime soon? Probably not. But for me personally, going forward, I think it's more of a chance of a cut from the Fed coming before there is a hike, which is the reason why markets are taking it as a positive spin so far. But that 5.5% interest rate, if that does have the desired effect on the economy, that maybe they do head towards a recession at some point next year, that's not really a situation where stocks enjoy themselves, but we'll cross that bridge when it comes to it. Stocks are bid now up nearly 7% on the week, 6-7% on the week, so biggest weekly gain across the S&P 500 year to date. Economic data does also suggest they are probably correct. Manufacturing PMI from the US below 50, but also below consensus. Consensus 49, actual 46.7. Bad manufacturing print on Wednesday before the decision. The job openings figures. Higher amounts of job openings throughout the economy. Consensus was for those to drop. Actual was for them was actual came in higher, 9.5 million, which indicates more jobs open, which is unemployment normally rises. Then after that, we then come into non-farm payrolls, a weak NFP print below consensus, below the previous, albeit previous pretty strong number, but consensus 1.8 or 1.880. You can see. I'll just click on this little here. Previous revised from 336, a downward revision from the previous month. Consensus 180, actual 150, and the unemployment rate ticks up somewhat unexpectedly. You can see consensus 3.8 up to 3.9, and just over the course of the last 15 minutes, the services PMI still above 50, consensus 53, actual 51.8, and that is a bit of a turn in economic data from the US, and that kind of reaffirms the Fed's stance on no more interest rate hikes. Then the Bank of Japan. The Bank of Japan have somewhat loosely removed the terminology in a part of their statement that suggested that the 10-year yield had an upper band of 1%. They removed that comment. Ultimately, then markets test that resolve, and the Bank of England step in. And what do? They buy bonds and keep yields below 1%. So markets had expected a bit more of a change, maybe to remove yield curve control, yield curve control completely, maybe even speak about hiking interest rates in the future. That did not come. Japanese yen weakened again, dollar yen pushed higher, but I think the Fed came in and reversed that move, which Bank of Japan will be happy for. But aggressive rise in yields to begin the week from Japan. Bank of Japan step back in to cool that. So a bit of a hawkish step from the Bank of Japan, under delivered on what markets had hoped for, but ultimately somewhat of a hawkish step from the Bank of Japan. Bank of Japan slightly hawkish. The Fed, Bank of England dovish on a week. That's not something you see too often. And you can see stocks across the board had the reversal stepping in on Monday. Kind of grinded higher for the most part on Monday, on Monday and Tuesday, and to begin with on Wednesday. But then once Wednesday kicked into gear, stocks have just accelerated higher. You can see the S&P, the Dow Jones, the Nasdaq, the Russell all smashing higher aggressively. You can see the DAX, the Euro stocks smashing higher aggressively. The FTSE not managing to get there to realise the same amount of gains. FTSE turning a little bit lower. The economy in the UK isn't as good as across the US either. Maybe the DAX and the Euro stocks probably pushing higher as they sense the ECB is done and interest rates are lower in Europe than they are across the other economies. But FTSE always struggles to gain as much meaningful upside. US stocks across the board, German stocks, European stocks, aggressive upside over the course of this week, albeit the FTSE still to close higher. You can see Aussie, Kiwi, Euro and Sterling all to notch weekly gains. Dollar Swiss, dollar CAD, dollar yen all moving aggressively lower. Dollar yen, you can see the move from the BOJ on Tuesday, a massive move to the upside, then almost completely reversed due to the Fed on Wednesday, and then NFP today. Dollar index, naturally everything else is down, so that is down with it. So dollar weakness across the board. Is that likely to continue? You'd have to imagine it probably is. Like if you look at the dollar index just by itself, it's come a long way since back in July. It's just rallied and it's rallied and it's rallied. You're now through these kind of lows across here. I think that's somewhat of a substantial break. It's not the greatest level the world has ever seen, but we can get through that, get a close below this level down here. I think that would be nice for some further downside. I think downside targets, next one probably 103 on the dollar index. And if you're going with the Fed, I say don't fight the Fed, but Fed backing out or changing their mind on interest rate hikes going forward. They have communicated that to the markets. I do think that they are probably closer to a cut than they are a hike. Neither of them will come anytime soon. We will not get a cut anytime soon, but in terms of what the next rate move from the Fed will be, you'd have to imagine it'd be a cut, won't you? Then we'll come across the yields. Yields have got smoked off the back of the Fed on Wednesday and then into today. 2-year yield, not as much. 2-year yield Wednesday, you can see down aggressively. Thursday just kind of chopped around, not doing too much, and aggressively to the downside again, which again further alleviates some pressure on stocks. Gold, though, interestingly, cannot notch any gains, right? Struggling to notch any gains. Now you've got there's no real reason to want to buy gold other than yields pushing lower, right? Yields pushing lower, normally positive for gold. That's not what we're getting. US dollar weakness, normally positive for gold. That's not what we're getting. So if these things do turn around, take a turn for the worst, I mean, I have to imagine probably the next move lower, or the next move on the price of gold should probably be lower. Struggling to make any meaningful upside, or start struggling to continue the upside. You've got Israel and Hamas's, I don't want to say calm down because not calm down, bombing has continued overnight, but no other countries have got involved. Nothing of note, really. It's gone a little bit quiet on the news front over there, certainly in terms of the financial news sources. Obviously, the humanitarian aspect of it is terrible. In terms of what its meaning for markets, it doesn't really mean too much for financial markets at this present moment in time. So, gold, certainly not the one to be looking at the moment. Stocks, bonds, US dollar is the assets, or are the assets to look at heading into next week. So, yeah, pretty wild ride over the course of this week. Number of things to think of as we head into next week, but we'll update further on that as and when we get to it. So have a good weekend. Do get some rest and relaxation, and recharge the batteries, and we'll speak to you all again next week.